Last night, the president went on national television and, well, he declared an absolute military victory in Kentucky.
Right.
The exact quote that crossed the wires was, "We won. In the first hour, it was over." But, at the precise second, those words were being broadcast.
Literally the exact same time.
Yeah, exactly. Advanced underwater drones were successfully detonating commercial shipping vessels in the Persian Gulf. So, welcome to the deep dive.
Glad to be here.
Today, we are looking at a 24-hour period where basically the political narrative and the physical reality of the global supply chain they violently broke apart.
It is, it's a profound decoupling. I mean, when you look at the terminal data today, we are transitioning instantly from theoretical risk.
Where the algorithms just, nudge oil prices up a few % based on some headline.
Exactly. We're transitioning from that into realized, unmitigated logistical paralysis.
And before we get into the actual mechanics of that paralysis, a really critical note to you, the listener.
Yeah, this is important.
Today's deep dive covers some highly charged political rhetoric and, well, rapidly escalating kinetic military actions. We are keeping this strictly clinical.
Strictly.
We are impartially reporting the data provided in today's intelligence. We are taking no sides, and we are not endorsing any political, executive, or military viewpoints.
Right. Our only mission today is to analyze the mathematical and macroeconomic implications of this massive microstructural shift.
Exactly, because we need to look at what the models were pricing in yesterday versus the physical reality the market is waking up to today, March 12th, 2026.
Because the algorithmic risk models are, well, they're fundamentally failing to map the current threat vector.
Okay, so let's unpack this carefully, because the operational fallout here isn't just, a headline. It's incredibly messy.
Chaotic.
Yeah. So to understand why the models are failing, let's look at the kinetic reality. What we knew yesterday was that the market was pricing in a relatively contained conflict. It was focused on aerial bombardment, traditional surface naval skirmishes. It felt like a known equation, right?
Yeah, that's the key. Yesterday, the assumption was that traditional surface threats can be countered by standard Western naval air defense systems.
Right. A missile is fired, radar tracks it, a destroyer intercepts it.
Exactly. But what is new today fundamentally mutates that threat. Iranian asymmetric forces deployed advanced underwater drones.
And these aren't like theoretical prototypes, right?
No. They successfully struck 2 commercial vessels engaged in a ship-to-ship transfer near the Iraqi Basra port.
The U.S.-owned Safe Sea Vishnu and the Greek-owned Zephyros.
Right. And tragically, an Indian sailor was killed in the strike.
And the cascading effect of that specific technology is it's staggering.
It really is.
Iraqi terminal operations at Basra are now fully suspended. The threat radius didn't just stay in Iraq either. It expanded hundreds of miles south to the UAE.
Yeah, a container ship was hit near the vital Jebel Ali transshipment hub.
And the attacks are hitting terrestrial infrastructure too, right?
Yeah, Bahrain's airport fuel tanks in Muharraq were struck. Oman's Mina Al Fahal terminal had to be precipitously evacuated.
It is so chaotic right now that commercial ships in the Gulf are they're desperately altering their AIS transponder.
Their maritime identification signals.
Right. They're changing them to broadcast the words China owner, just hoping to, avoid being targeted.
It's a stark illustration of your opening point. The markets are pricing in this political hologram of victory while, the physical supply chain is quite literally burning.
Okay, but help me understand the specific math here. I mean, we've had conflicts in the Strait of Hormuz before. Ships have been targeted before.
Sure.
So why does the introduction of this specific underwater drone technology mathematically invalidate the existing maritime insurance models? Like, why is this time actually different?
Well, it completely breaks the math of deterrence. If you think about how an actuary at an insurance company prices a war risk premium, it relies heavily on the presence of a deterrent, like a U.S. naval destroyer. As I mentioned, if a surface missile is fired, the destroyer's radar sees it.
So the insurance company prices the policy based on a very high probability that the military will intercept the threat.
Exactly, meaning the commercial ship survives.
The insurer is just betting on the Navy's radar.
Precisely. But an underwater drone operates below that conventional defense umbrella.
Yeah.
It largely evades standard Western surface radar.
Oh, wow. So they literally can't see it coming.
Right. So the probability of interception suddenly drops effectively to 0.
Wow.
And if the defense mechanism cannot see the threat, the probability of catastrophic loss approaches 100%.
Right, and you cannot mathematically underwrite an insurance policy when the loss of the asset is a certainty.
Exactly.
Mm.
Insurers are forced to either geometrically multiply the premiums to levels that wipe out any profit margin for the shipping company,
Or they just, what, refuse to cover them?
or they simply refuse to cover any vessel entering the Persian Gulf. And without insurance, ships do not sail. That equals immediate, unmitigated logistical paralysis.
And if the Gulf is mathematically paralyzed, that physical destruction directly forces an economic intervention within the same 24-hour window
It has to.
because the energy stops flowing.
Mm.
Which brings us to the next massive shift, the sovereign liquidity trap.
Right.
What we knew prior to today was that global energy markets were incredibly tight, but central banks felt they had traditional baseline reserves to prevent a severe stagflationary shock.
Yeah, they believe they had an adequate buffer to absorb a temporary disruption.
But what is new today proves how rapidly that buffer is dissolving. I mean, the panic is absolute.
It really is. The International Energy Agency just authorized the largest coordinated strategic petroleum reserve liquidation in human history.
400 million barrels are being released.
Right. And to put the sheer scale of that into context, the United States Department of Energy is dumping 172 million barrels of that total.
And that's over a 120-day discharge cycle, right?
Exactly. That massive drawdown pushes U.S. reserves down to devastating 40-year lows.
Yeah.
At the exact moment a multi-theater war is actively expanding.
I mean, it completely dwarfs the historic 180 million barrel release we saw back in 2022.
It's not even close.
So treating this clinically dumping 172 million barrels into the market right now is the macroeconomic equivalent of treating a severed artery with a temporary tourniquet.
That's a good way to put it.
Right. It stops the bleeding today, sure. But it has a built-in expiration date. That tourniquet automatically pops off in 120 days.
And then you're right back where you started.
Exactly. So what happens to the Federal Reserve's inflation models when we hit late summer? This finite buffer runs dry, and those Iraqi export terminals are still offline.
Well, that is where the math for the Federal Reserve transitions from difficult into a true paradox.
A paradox.
Yeah. It creates a textbook, inescapable liquidity trap. When that 120-day discharge cycle concludes, the artificial supply vanishes instantly. We hit an unmitigated supply cliff, and headline inflation will violently reaccelerate due to the energy shock.
And normally, the textbook response to inflation is for the Fed to aggressively raise interest rates to crush demand, right?
Yes. But here's the trap. The U.S. Treasury is simultaneously issuing geometric amounts of unbudgeted sovereign debt to finance this escalating multi-theater war.
Oh, right.
So if the Fed raises rates to fight the oil inflation, the interest payments on all that newly issued war debt become mathematically unsustainable.
The government would essentially be unable to afford its own mortgage payment.
Exactly. It would trigger a sovereign debt crisis.
So they literally can't raise rates without bankrupting the Treasury.
Nope.
But wait, what if they cut rates or just hold them where they are?
Then that supply-side energy inflation runs completely out of control. The cost of everything transported or manufactured skyrockets.
Man.
They are trapped in a pure stagflationary paradigm. They cannot hike and they cannot cut.
Which makes the next data point from today's intelligence almost surreal.
It really is.
Because at the precise moment, the Western Alliance is exhausting its emergency energy buffers and, cornering its own central bank.
Yeah.
The U.S. executive branch is deliberately engineering an additional massive friction point in global supply chains. Let's look at the fractured trade architecture.
This is a massive shift.
Yeah. What we knew recently was that the U.S. Supreme Court had temporarily invalidated previous attempts at sweeping global tariffs.
Right. It looked like the judicial branch had paused the protectionist momentum.
It provided a brief moment of relief for global logistics networks. But what is new today bypasses the courts entirely.
Completely.
The United States Trade Representative has launched a legally fortified Section 301 investigation, and the scope of this is staggering.
It's massive.
It targets 16 distinct national economies over, quote, structural excess capacity. Now, obviously, it targets adversaries like China.
Sure.
But the key detail here is who else is on that list. It explicitly targets critical allies and vital manufacturing hubs, the European Union, Japan, South Korea, India, and Mexico.
Look, this is the active, legislated unglobalization of the supply chain.
Unglobalization.
Exactly. And structural excess capacity is essentially a bureaucratic mechanism used to penalize foreign state subsidies,
So it's a loophole.
basically.
Mm.
By utilizing Section 301, the executive branch circumvents judicial roadblocks and forces multinational corporations to execute incredibly costly multi-year supply chain migrations away from those 16 targeted regions.
But I have to stop you there because the timing is just wild.
Yeah.
Why target your own critical allies like Japan and the EU at the exact moment you are facing a multi-theater conflict and an energy crisis?
Well, from a purely clinical perspective, it represents a profound pivot toward absolute domestic industrial protectionism, regardless of the geopolitical collateral damage.
So they're just, prioritizing domestic factories over the alliance?
Exactly. The calculation is that securing domestic manufacturing supremacy is more critical than maintaining the cooperative trade architecture of the Western alliance.
Right.
But the immediate mathematical result is that the cost of imported goods, components, and raw materials from those 16 nations is going to spike dramatically.
Okay, so put yourself in the shoes of an institutional portfolio manager listening to this right now. You're sitting on a traditional 60-40 portfolio, 60% equities, 40% bonds.
Standard baseline.
Right. In a high-friction regime where unmitigated energy shocks and 60-nation trade wars are colliding, how does that traditional portfolio avoid complete margin compression?
Mechanically, it cannot avoid it.
It can't.
No. The entire foundation of the 60-40 portfolio is built on a negative correlation between equities and bonds. Right?
When one goes down, the other goes up and provides cover.
Exactly. But in this specific stagflationary environment, both sides of the portfolio are attacked simultaneously.
Okay, explain how it bleeds from both sides.
Let's start with the 60%, the equities. Corporate profit margins face severe compression because the cost of raw inputs and energy are exploding due to the Strait of Hormuz blockade.
Right, the energy shock.
Right. And localized labor and component costs are surging due to the Section 301 tariffs. So equity valuations drop.
And the bonds, the 40%.
The 40%, the sovereign bonds are decimated because the underlying fiat currency is being debased.
Oh, because of the debt issuance.
Exactly.
Yeah.
The massive debt issuance required to fund the military escalations increases the supply of bonds, while that sticky, unmitigated inflation we just discussed erodes the bond's real yield.
So the traditional safe haven provides absolutely no cover. It's a synchronized drawdown,
Correct.
which perfectly explains the final and perhaps most significant microstructural shift we are observing today.
Yeah, the digital side.
Exactly. If traditional fiat stabilization tools are exhausted and global trade is actively fracturing, institutional capital has to go somewhere.
It always finds a way.
Right. And it is being systematically forced into the only decentralized architecture capable of absorbing this exact macro friction. Let's talk about Bitcoin's microstructure and the mutation of corporate shadow banking.
Because the contrast between traditional asset panic and Bitcoin's behavior today is striking.
It really is. What we knew over the last few months was a story of continuous ETF inflows and passive corporate treasury accumulation.
Companies were buying it, but they were just holding it on the balance sheet.
Right. It was treated primarily as digital gold in a vault, passive defense. But what is new today, and here's where it gets really interesting, is that in the last 24 hours, corporate adoption has mutated from passive hoarding into active shadow banking.
That's the real shift.
And the Bitcoin spot market is demonstrating total indifference to the macro panic we just detailed. Right now, Bitcoin is tightly consolidating near $69,795.
And we have to highlight that divergence. Traditional risk models are breaking down, supply chains are burning, yet this digital bearer asset is holding its exact baseline.
Exactly. So let's look at the on-chain data proving why. The short-term holder spent output profit ratio, the STH-SOPR, is currently hovering below 1.0.
Which is very telling.
Yeah. And at the same time, we saw $115.2 million in positive U.S. ETF inflows today.
That was heavily dominated by BlackRock's IBIT patent.
Yeah, and we even saw a tactical fee rotation where capital moved out of Grayscale's legacy GBTC and into its lower fee mini trust.
So institutions are actively managing this.
Exactly. And Solana spot ETFs also captured $1.66 million, showing this liquidity isn't isolated to just one asset.
Right.
And alongside this, the domestic regulatory cleanup continued today, with federal prosecutors formally denying Sam Bankman-Fried a retrial.
That last point, It shouldn't be overlooked.
Right.
Denying the retrial is the final stage of domestic regulatory sanitation.
Sanitation, I like that word.
Yeah, the legacy fraud of the previous cycle has been formally expunged, making these new regulated institutional integrations legally defensible for corporate compliance departments.
The space is sanitized, but I want to go back to that STH-SOPR metric because it ties directly into the most vital piece of corporate intelligence today, which is happening in Japan.
Metaplanet.
Exactly. Metaplanet, a firm holding over 35,000 Bitcoin, completely evolved its strategy today. They aren't just holding it anymore.
No, they're not.
They committed $25 million to a new venture arm, starting with a direct investment in the JPYC fiat-pegged stablecoin.
Right.
And simultaneously, they launched a Miami-based asset management platform specifically designed to connect Asian capital with Western digital credit markets.
They are actively laying the pipes for a closed-loop parallel financial system.
Exactly. They aren't just stockpiling digital gold in a vault. They are building plumbing right on top of it.
Exactly.
So I have to ask you, does this integration of regulated fiat stablecoins and offshore Bitcoin yield mathematically prove that the asset has permanently decoupled from being treated like a risky high-beta tech stock?
Yes, absolutely. And the mechanism proving it is the exact STH-SOPR data you mentioned a moment ago.
Okay, give me the translation on that. How does STH-SOPR prove it?
Well, think of STH-SOPR as a panic meter for new investors. When that metric sits below 1.0, it empirically proves that recent market entrants' weak retail hands are looking at the news about underwater drones and tariffs, panicking, and selling their coins at a nominal loss.
They are locking in a loss just to escape the volatility.
Exactly.
But the price isn't dropping. It's holding near $70,000.
Precisely. And why is that? Because apex fiduciaries like BlackRock and corporate entities constructing these shadow banking networks like Metaplanet are placing impenetrable bid walls right below the market price.
Oh, wow. So they're actively absorbing that retail fear.
Yes. When an entity like Metaplanet integrates a fiat stablecoin with a massive 35,000 Bitcoin treasury, they are creating a sovereign credit facility.
Right.
They can issue loans, generate yield, and move massive amounts of capital entirely outside the traditional, highly constrained commercial banking sector.
That's huge.
They are treating Bitcoin not as a tech stock to be traded on Robinhood, but as the foundational collateral of a new, frictionless economic layer.
So what does this all mean for you, the listener, as you look at your own risk modeling today?
That's the real question.
You are watching, in real time, the mathematical exhaustion of sovereign fiat buffers. You have burning ships and underwater drones completely neutralizing traditional military deterrence.
Breaking the insurance models.
Right. You have a historic, desperate draining of strategic petroleum reserves that acts as a 120-day tourniquet before an inflationary cliff.
The liquidity trap.
Exactly.
Yeah.
You have the executive branch deliberately fracturing global supply chains with a 16-nation tariff war that actively targets our own allies.
Unglobalization.
And all of this is colliding with the rapid, highly capitalized hardening of an unseizable, decentralized financial infrastructure.
The physical reality is dictating the necessity of the digital architecture. The legacy system is experiencing terminal friction, so capital is routing to the only network with zero friction.
Which brings us to one final provocative data point from today's intelligence for you to mull over. The Bitcoin Premium Income ETF, the BPI, just officially declared a dividend.
Yeah, that's wild.
Think about the mechanics of that for a second. Base layer cryptographic assets are now generating standardized traditional finance dividends at the exact moment global fiat yields are trapped by stagflation and multi-theater war.
It's a profound structural inversion. I mean, it's a mathematically scarce, decentralized bearer asset can function as the foundation for regulated yield-generating credit markets during a global liquidity crisis.
Right.
It forces us to ask a very uncomfortable question about traditional finance.
What's that?
Does the macroeconomic definition of a risk-free rate even exist anymore? Or has the risk simply transferred from the asset to the fiat currency itself?
The diagnostic machine isn't just broken, it's measuring a hologram. While the political establishment broadcast a hologram of victory today, the physical supply chain was burning, and institutional capital was quietly migrating to the only asset class engineered to survive the fire.